Jim Cramer ran through all 32 companies in the Investing Club portfolio during the February monthly meeting on Thursday. Here's a rapid-fire look at what he had to say on each stock. 1. Apple. 1. Some obstacles facing Apple include the stock's unusually high valuation, sluggish iPhone growth, and continuous uncertainty in its China market. 1. Still, Apple remains an own-don't-trade name in our portfolio. 1. Apple has a lot going for it, like its growing service revenue stream. 2. Abbott Laboratories. 3. Consider Abbott the poster child of the comeback kids in our portfolio. 3. The stock is up nearly 20% since mid-January, as worries over the litigation risk for its specialized infant formula has eased. 3. 2 reasons to stick with Abbott after its big run. Shares should never have been so depressed to begin with, and it has many growth areas including glucose monitoring. 4. Amazon. 5. All the e-commerce and cloud computing giant seemingly does is make money, and it is Jim's favorite among the hyperscalers right now. 5. He said he likes the stock at current levels. 5. Improvements in its European operations and advertising are among its less discussed potential growth drivers. 6. Broadcom. 7. CEO Hock Tan's next move is uncertain, though a recent report suggested Broadcom is kicking the tires on Intel's chip design business. 7. Broadcom doesn't need Intel's intellectual property to thrive in key growth areas like AI, but weakness on Intel-related headlines could be buying opportunities. 8. Best Buy. 9. Jim expressed his concern about this position flipping from a solid gain into a loss, and accordingly, we exited our stake in the electronics retailer later on Thursday afternoon. 10. BlackRock. Shares of the world's largest asset manager have underperformed the S&P 500. 1. So far this year, but we're not concerned. Its growth prospects remain strong, especially in private markets following a slew of recent acquisitions in infrastructure and private credit. 1. We added to our position Wednesday, and Jim signaled he still views the stock as a buy. 2. Bristol-Myers Squibb. 3. Patience is required with the drug maker because its new schizophrenia drug, Cobenfy, is still in the early innings. 3. While it has immense potential to treat brain-related conditions, it won't be an overnight commercial success. 3. Stay the course, Jim said, and buy some shares if they fall further. 4. Costco. 5. The weak January retail sales data underscored why we own Costco. 5. The membership-only retailer can do well in any environment, including when consumers are cutting back thanks to its reputation for offering the best prices. 6. Salesforce. 7. Agentforce may become the enterprise software maker's most successful product ever launched, and Jim recommended buying the stock before it bounces from its recent pullback. 8. CrowdStrike. 9. Shares have been on a tear in recent weeks and was the top performer in the portfolio since the January monthly meeting. 9. That's why it was necessary to sell some shares Wednesday. 9. Jim said we could see some profit-taking when the company reports earnings in March, but we'll play through it. 10. Coterra Energy. 11. We're standing firm on the oil and gas producer, which occupies a critical lane in our portfolio as a hedge against higher energy prices. 11. It also stands to benefit from growing power consumption tied to AI. 12. DuPont. 13. This stock remains in breakup purgatory as investors wait for the company's electronics division to be formally spun off. 13. But its lackluster recent performance isn't enough to scare us away. 13. Jim still sees shares going to the $100 level, up more than 21% from Wednesday's close. 13. That's why we'd be open to buying more DuPont, because the sum of its parts is indeed worth more than the whole. 14. Danaher. 15. Jim reiterated his belief that Danaher's board should replace CEO Rainer Blair to right the ship at the life sciences firm. 15. He said if the board doesn't recognize that need, then this isn't the Danaher he's known and appreciated since the 1980s. 16. Disney. 17. We wish this stock was doing better, but shares still look ridiculously cheap, and the company has plenty going for it, including improving streaming profitability, even if the perception is that it's not as good as Netflix. 17. We bought more last week. 18. Dover. 19. This industrial stock with AI ties is ready for its next move higher, Jim said. 19. While Dover shares took a hit on the DeepSeek-induced global sell-off late last month, The company posted a stellar quarterly earnings report a few sessions later that assuaged Wall Street concerns. 19. Shares are within a few dollars of their record close of $206.51 set on November 27. 20. Eaton. 21. Another industrial AI play that sold off on the DeepSeek news, Eaton has also since shown that its lucrative data center business isn't slowing down despite the emergence of the Chinese AI startup. 21. Sure, quarterly revenues were a touch below estimates, but we're not changing our tune on our big-picture outlook, even as it remains well below its pre-DeepSeek levels. 21. Jim did say he prefers Dover over Eaton right now, though. 22. GE Healthcare. 23. The maker of MRI machines is another comeback kid in the portfolio, thanks to strong quarterly results and, crucially, issuing prudent guidance for 2025 that should be achievable. 23. In the past, overpromising and under-delivering had been a problem for the stock. 23. Now getting to $100 a share is doable. 24. Alphabet. 25. The Google parent's quarterly results weren't that great, but we're staying invested in the company for one reason. It has so many levers it could pull to accelerate growth that the stock could explode higher the day after we exit. 26. Goldman Sachs. 27. We continue to expect the Wall Street Titan to see a boost to its investment banking revenues as deal-making picks up. 27. That's a key reason we started a position in this bank stock. 27. Although IPO and M&A activity hasn't rebounded as much we hoped so far this year, we're still confident in our thesis. 27. Jim said the stock can be bought at current levels. 28. Home Depot. 29. While interest rates matter to Home Depot, the linkage is not as direct as it is for a home builder. 29. Our belief is rates will ultimately trend lower, sparking more housing activity in a positive way for Home Depot. 29. In the meantime, it should benefit from rebuilding efforts from hurricanes and wildfires. 29. Play the long game here. 30. Honeywell International. 31. We've been rebuilding our position as shares trended lower in recent weeks ahead of Honeywell's planned split into 3 independent companies. 31. If executed successfully over the next year and a half or so, it should be a boon to shareholders and allow its aerospace business to get its time in the sun. 31. As part of the split, though, Jim said its automation division needs to be cleaned up. 32. Linde, a leadership shakeup at one of Linde's few competitors, Air Products. 1. Could end up benefiting Linde by enabling it to charge higher prices for its industrial gases. 1. Linde has delivered for investors in the old regime, Jim said, so imagine how great it could get in this competitive environment. 2. Eli Lilly. 3. Some investors may be getting bored with a consistent winner like Eli Lilly, but we're not among them. 3. Demand for its GLP-1 obesity drugs looks robust, and a number of trial readouts loom that could be bullish for the weight loss category. 3. Robert F. Kennedy Jr. leading the Department of Health and Human Services is a wild card, but Jim said Kennedy understands the promise of GLP-1s. 4. Meta Platforms. 5. The Instagram parent's stock has had a miraculous run, which included a recently snapped 20-session win streak. 5. And yet Meta shares are still the cheapest among the hyperscalers when factoring in expected earnings growth. 6. Microsoft. 7. Our view on the software and cloud provider is similar to where we stand on Alphabet. 7. Its quarter didn't blow us away, but there's so many growth levers the company can pull that exiting the stock could easily come back to bite us. 8. NVIDIA. 9. The DeepSeek episode gave us real concern about whether NVIDIA's most important companies would cut back on their AI chip spending, but Amazon, Meta, Microsoft, and Alphabet all indicated they were still moving full steam ahead on capital expenditures. 9. That cleared the decks for the stock to rally. 9. Jim reiterated his own don't-trade view. 10. Next tracker. 11. We're on the fence with the solar technology company despite recently reporting an excellent quarter that reinforced Jim's belief in management's prowess. 11. However, it's hard to say how much that will matter with a White House that's not conducive to the clean energy subsidies that benefit Nextracker. 12. Palo Alto Networks. 13. Shares were dinged directly after its quarterly earnings release last week. 13. Despite posting a solid full-year outlook, Jim said the bears unfairly targeted the cybersecurity stock. 13. Wall Street later came to its senses, and the stock surged to record highs before pulling back in recent days. 13. We're sticking with Palo Alto and are upbeat on management's platformization strategy. 14. Starbucks. 15. The coffee chain has made a turn of astounding proportions, as CEO Brian Niccol works fix problems that hurt sales such as long wait times for drinks. 15. The company hasn't been a well-oiled machine in years, which is why the stock has come back and can keep climbing. 16. TJX companies. 17. Like Costco, the parent company of TJ Maxx, Marshalls, and Home Goods has a reputation for offering good merchandise at great prices, so it's worth owning regardless of the economic landscape. 17. Tariffs are a question mark for the retail industry, but we see TJX as a relative beneficiary. 18. Texas Roadhouse. 19. We'll hear from the restaurant chain after the closing bell Thursday, its first quarterly report since joining the portfolio Feb. 4. 19. There could be some weather-related noise around its first quarter commentary, but bigger picture, its good food at surprisingly low prices should still be a winning recipe. 20. Wells Fargo. The bank continues to make progress with regulators and is now even closer to getting its $1.95 trillion asset cap removed. CEO Charlie Scharf's strides to clean up the bank's past misdeeds have been impressive, and we remain excited to see how Wells will grow its budding businesses once the Fed-imposed cap is lifted.